Good morning. Welcome to Daily Mortgage Rates Live with the Mortgage Calculator. We're going to go through our live mortgage rates, and then we're going to do a deep dive into self-employed borrowers. Give us just a minute here to get up and running on all the different platforms. We put the chat up on the screen. Go ahead and drop a comment there in the chat as you tune in. I see some comments already coming in. We appreciate it. And we'll get started here in just a moment. Happy Friday, everyone. And again, those just tuning in, go ahead and drop a comment there. We'll get started here in just a moment. All right. Okay, looks like we're live on all the different platforms, so we'll go ahead and get started. We're going to take the chat off the screen, but keep dropping comments in the chat. Drop any questions you have in the chat when we go through our deep dive topic here as well. But we'll go ahead and take it off the screen for now. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender, and what we do every morning at 11 a.m. Eastern time on this show is go through our actual live mortgage rates, and then we do a deep dive into a different loan topic. Today's topic is going to be self-employed borrowers. So this is something that we specialize in here at the Mortgage Calculator. I'm sure Jose has a plethora of options for our self-employed borrowers because that is what we do here. So we'll go through that here shortly, but before we do, let's go ahead and pull up our rates. So Nick, if you're ready, let's go ahead and use the pricing tool and see what the market is looking like this morning.
All right. Let me go ahead and switch my screens and we will check it out. So as Kyle mentioned, this is our pricing tool. This will show us the general rates and the APR. For today, it is March 8th, just after 11 a.m. Eastern. So we have all of our standard programs here live. If you'd like a full breakdown, a loan estimate that itemizes all the fees that go into the APR, please get with our team members. We have over 300 licensed loan officers. For our demo here, as we do every day, we'll set up a basic scenario. We'll set a $400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment. We'll set the price here so we can find the lowest rates we can offer for conforming conventional. And then we'll check out FHA, which is usually the second option for most borrowers. And then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional options. We also offer VA and USDA. VA is only for eligible vets and active service members. If you are, just let us know. And USDA is only for eligible properties. If you do happen to be looking, just let us know. But today we'll start with conforming conventional. We'll do a purchase, 30-year fixed standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos here, we use an estimated FICO score of 760 and an estimated debt to income ratio of 40%. So with these settings, let's check out the rates today. All right. Pretty much the same as yesterday, 6.375 rate, 2.5 discount points and costs, puts the final APR at 6.672. I believe that's the same as it was yesterday. So good option for our customers looking for conventional. Now, if our customers don't qualify for conventional for any reason, the next option we usually want to compare is an FHA option. So we'll set up the same exact scenario here. This time we'll select FHA. Everything will stay exactly the same. FHA does allow more leniency on credit issues, as well as a much higher debt to income ratio, but we'll keep everything identical here so that we can compare apples to apples across the programs. And again, about the same as it was yesterday, 5.625 rate, 2.375 discount points and cost, puts the final APR at 6.558. So in this case, FHA is a touch cheaper than conventional if our customer qualifies for both. So definitely recommend our customers check that out. And this APR does include the upfront and yearly mortgage insurance that is required for FHA. So it is a great option for our borrowers that need to use it because it's almost identical to conventional costs here, at least today, and actually a touch cheaper in some cases. So definitely a great option for our customers that need that flexibility. Now, where we love to specialize, and I'm sure Jose will present a bunch of options here, is for our borrowers who may not qualify for conventional or FHA. Many other banks or lenders have to deny those customers, but that's where we love to present our alternative options here. under expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs using alternative income. So we'll keep everything the same, but now we have a new option where we can change the income type. So full doc is what we use for conventional and FHA. That's 2 years of tax return. So if our customer doesn't qualify using 2 years of tax returns, we need to use one of these alternatives here. We have asset-related programs, business bank statement, investor DSCR just for investment properties. We'll show those in a minute here. Personal bank statement 12-month is what we use for the demo. That's the most popular program. We have RSU, stated income, VOE, 1099, P&L, no income CDFI. But again, the most popular is the 12-month bank statement, and that's for our self-employed borrowers. Many times when our self-employed borrowers submit 2 years of tax returns, may have various write-offs and may not qualify at all, or just need a little bit more income. We'll solve that problem, no tax returns at all, just their last 12 bank statements, and determine a new debt-to-income ratio here of 40% in our example, using just the cash in the bank, no tax returns at all. So many of our self-employed borrowers will qualify for much more income this way. So let's check out these options today. Ooh, I think that's a little bit lower than it was yesterday too, which is awesome. So 6.875 rate, 2.425 discount points at cost, final APR of 7.282. And as I mentioned, these non-QM rates do take a little bit to come down. So we saw some of the conventional stuff come down last week and earlier this week. And now we're seeing these non-QM options come down as well. So tons of great options here. And you can see they're within about a half a point of conventional. For our customers that need to use them, very amazing programs. And if we scroll down here, there's hundreds of variations. Some of these towards the bottom may allow things like bankruptcies and foreclosures and other issues that would cause us to not qualify. So lots of options here. Please get with our team to find the one that fits best. And Jose will probably go through a bunch of options as well today, since this is our topic. And for our final couple demos, we want to do some investment property pricing here. So for investors, first-time investors, seasoned investors, we have some great options. We'll set the same scenario, $400,000 loan, 80% loan to value, 20% down payment. And we'll find the lowest rates we can offer for conforming conventional for investments, and then we'll compare that to non-QM expanded guideline options. Remember, the government programs, FHA, VA, and USDA do not work for investments. So we'll start with conforming conventional here. Everything will stay the same as our other demos. We've only edited the occupancy here. So let's see if we've closed this gap on the portfolio option yet. We've been watching this for the last week here or so. Frozen? Come on. Am I frozen?
No, you're fine.
Okay, there we go. Finally kicked in. I guess my internet was tweaking for a minute there just on this page. Okay. So, the non-QM dropped a little bit here. So this portfolio option is still on top of the list. So this is a great option. It's not a true conventional. It is signified here as portfolio, meaning it is a full doc conventional loan guidelines, but it's not actually sold to Fannie or Freddie. It's a portfolio option. So this one doesn't need the price adjustments that are required for Fannie and Freddie. So this one comes in at 6.875 rate for 3.125 discount points at cost, puts the final APR at 7.251. And then our first true conventional option is a Freddie Mac option here, 6.99 rate, 3.25 discount points at cost, and a final APR of 7.382. And this does include the loan level price adjustments that are required for conventional. So definitely recommend our investors check out this option, the portfolio option, but also our non-QM options we're going to pull up here in a second. And this gap should start to close if the conventional rates drop down, and we should see the true conventional come up to the top here, as is normal for the markets. Should see that soon, we hope. And for the final demo, we will set up the same scenario. And this time, we will choose expanded guidelines, also known as non-QM. So for this option, the first thing we need to select is our income type, most popular income type. And the most popular loan we do is our DSCR loan because it doesn't require any income or employment or documentation on that from our borrower. Simply use the estimated rental income listed on the appraisal to determine a DSCR value. The estimated rents can cover the expenses, aka the property will cash flow. That's a ratio of 1 or higher. We even have options for properties that don't cash flow and the ratio is under 1. For the demo, we put 1.5 always so we can see the most common options. And prepayment penalty is standard for a non-QM investment, so 3 years is what we'll use for this. We can select 0 prepay, that will cost more money, but does limit the programs. And we can select 5 years, which does save some money, but does limit the programs that show up. So we can see all the most common programs. We'll select 3 years, as we do every day for the pricer. So DSCR rates, not quite beating the portfolio option by just a hair here, but I would still say 100% of investors would take this. Best DSCR option at the top, absolutely smoking. 6.75 rate, 3.4 discount points and cost, puts the final APR at 7.256. Remember the portfolio option was 7.251, I believe, just a second ago. So almost identical, and I would say 100% of investors would choose this DSCR option, even when it's more expensive. And today it's beating conventional and almost beating the portfolio option that we have there. So absolutely smoking. All the investors check out these DSCR options. And if we scroll down, some of these options here towards the bottom at a little bit higher rates and costs may allow things like bankruptcies, foreclosures, other types of credit events, may allow us to use different type of income. We had a couple episodes on that last week on short-term rental income being used. So check out some of those episodes to see all the variations here. Now let me switch my screen and we'll get into today's topic, which is going to be a deep dive into self-employed borrower loans. So on the live pricing demo, I always do a non-QM example there for primary borrower bank statement example, most common, but we have a ton of options specifically for our self-employed borrowers. So Jose is the expert at this, definitely something that he loves to do. Almost all of his loans are using alternative types of income and for self-employed borrowers. And remember, especially since COVID, self-employment has increased significantly across all of the different borrower tiers of the U.S., right? So even older folks now getting self-employed, younger folks, obviously self-employment is one of the only options they've had since the pandemic. And even just regular folks that have a job also add self-employment as additional income. So this is ever more important in our society today as self-employment and kind of the gig economy, right, is skyrocketing. So tons of options for those people that are taking advantage of self-employment, whether it's their primary or additional employment. So Jose, if you're ready, let's check out some options for this new wave of borrowers.
Absolutely. Why reinvent the wheel, right? We all know that non-QM loan production has increased where agency loan production has decreased. That was just an obvious. You were given the data, right? Interest rates increased from where they were in January of 2022. So those people that were approved, pre-approved, let's say full docs, in the process of trying to find their home, and then all of a sudden rates double from 3% to 6%, 6.5%, 7%. And now their affordability went down, their qualification went down, but the prices on most of those homes did not go down. So obviously, we had a transition in increase of self-employed borrower origination. And we're basically not talking about increasing the full doc self-employed borrower origination using traditional methods, but the non-QM alternative doc like bank statements and profit and loss. And even though not income related, which is actually the good part, an increase in DSCR origination with self-employed borrowers just didn't want to have to jump through those hoops of fire. And plus, another thing to consider, this is another big one, right? There's a lot of money going into secondary on those non-QM alt doc products. Secondary loves the DSCR, where it's not based on the income of the borrower, but the rental income generated by the property. They also love the bank statement loan program where you can see the deposits going in to the account. So those are all good methods. and very popular methods that have increased in their popularity. So when secondary increases its appetite for something, that usually means you're going to have more competition, more options, hence the rates and the guidelines get better. Rates get lower and the guidelines get a little looser for those products because they want to spur more activity in those products, right? It's not that there isn't money in secondary for loans, they just didn't really have the appetite for it in the agency side, but definitely have the appetite for it in the non-QM side. So let me go ahead and share all these amazing self-employed borrower loan options that we have here for you. Now, keep in mind the intertwining thread here in the self-employed borrower loan is qualifying the borrower based on their income. So the challenges we're usually going to face when going full doc will be either the borrower has too many business expense write-offs, or in some of the cases of our investors, they have 20 or 30 properties. It's just a hot mess trying to do that deal. Their paperwork is all over the place. They got a bunch of projects going on. They have a bunch of initial startups going on, so you have greater expenses in the first year. And then if you want to get those not considered, you got to come up with a bunch of explanations. Oh yeah, that was a one-time capital expenditure to replace the roof on 7 properties. So the investors don't necessarily want to go and have to jump through those hoops of fire when, as Nick mentioned, and you saw, the rates were pretty competitive and comparable from agency to DSCR, and in some cases better when you consider the loan to value. So our first example here, again, is our self-employed borrower, an investment property here, full doc, closing in their personal name. So this would definitely be an agency loan. If it would qualify for an agency loan closing in their personal name. And we're assuming here our borrower qualifies, and this is 80% loan to value. And these are pretty much our best options, right? 7.5% lowest cost options, 7.375 lowest rate options. Not that many options for an 80% investment purchase agency. Now I have the same scenario, pricing it out. Your self-employed borrower, conventional 1-unit primary purchase full doc, not going investment. So this is just
Jose. We had a question on Instagram here. You might want to touch on while you're going through these. Someone was asking about jumbo loans for self-employed. All of these are jumbo, correct?
Yeah, I mean, jumbo loan is just any loan above the Fannie Mae conforming limit. That's it. So in
correct.
That case,
these exampals are a little bit lower, but
right.
The same rates would be applicable for anything
for non-QM. Now we're talking an agency type loan. This is within the Fannie Mae limits here. I think I'm doing $500,000 purchase price. Correct. Here,
but the same rates would be applicable to a $800,000 or a $900,000 loan, which would be a quote unquote jumbo, correct?
Yeah, depending on the area. Now when we're talking about jumbo, we got our prime jumbo, which is a full doc loan. Mm-hmm. And then we have a lot of non-QM loans that are in the jumbo range that have all sorts of interesting income options, especially if we're looking at non-QM. At that point, it's just look at your maximum loan amount for that tier of LTV.
Exactly. There is no jumbo with non-QM, right? So all these examples we're looking at today will pretty much work at any loan amount up to a reasonable, 2,
right.
3 million. There's crazy limits on the top, but these are applicable to jumbo. So just wanted to touch on that. Looks like Mikey was in the IG live there. All these will apply to lower loan amounts or higher loan amounts. Non-QM, there is no jumbo limit technically.
The only thing that may limit you will be above a certain loan amount. There may be an LTV reduction. So in some cases, usually 1 million or 1.5 million for a lot of the conduits tends to be the cutoff for the maximum loan to value. Then above that, maybe from 1.5 million to 2 million, it's another LTV, and then from 2 million to 2.5, maybe another one. So that's something that's going to vary from conduit to conduit. But in, like you stated, Nick, in the non-QM world, there is no jumbo loan classification. That's an agency term only. So in this case here, this is our agency loan, conventional, 80% loan to value. This is purchase. This is just a self-employed borrower that qualifies via traditional measures. They have their tax returns for whatever automated underwriting told you needed, either 1 year or 2 years, and whatever document requirements automated underwriting told you that you need for your agency loan. That's what it is, up to a maximum. In this case, this is primary, and in this case, that was investment. 80% was the maximum on that one. So now we're throwing some extra items into the mix here. Now our self-employed borrower says, Jose, this is an investment property and I'm closing in an entity. In this case, the borrower is closing in an LLC. Now look at the difference here now. Look at the fact that we are now at 85% LTV in the non-QM world for an investment full doc purchase, right? So full doc, the same tax returns that we use for the agency loan are going to be used for this loan. In this case, we've chosen a 1 year option. So we get to choose the option here versus 2 year tax returns, 1 year option, 85% LTV, no mortgage insurance because mortgage insurance is never applicable. And then look at the rates here, which look pretty good, right? In the this is 85%, and if you recall, we were somewhere around here in our agency loan at 80%, a little bit lower cost, but we were at 80%. This is 85%, and you know that the investors love those higher LTVs. They want to leverage themselves out as much as they can because they want to buy multiple properties. So this is full doc, traditional, closing in an LLC, 85%. Now this is bank statement. Now we're getting into the alt doc world for real now. This is where we really, the examples we're talking about that have increased are the alt doc origination for self-employed borrowers because they're the ones that have the option to transition from full doc traditional to full doc self-employed and go from an income maybe of $7,000 or $8,000 a month using their net income on their tax returns to $30,000 a month using, let's say, 80% of the deposits if they're in a service-related business where it's just them running the business. Like I had one that was short-term rental property owner / manager, one-man shop, multiple properties. I was able to give him 80% of his deposits by default. No accountant letter needed, right? That's just one of the options there. So in this case, we're looking at 85% LTV again, and look at those rates. The rates are ultra competitive all the way down to our lowest cost option here, costing only a quarter of a point at 9.375. And check that out. You can buy it all the way down to 7.375. Nice deep rate sheet here at a cost of 3.375. For our bank statement option, 85% LTV. That's what I want you to focus on. That's the key here. Now, again, 1099 option instead of bank statements, 1099s. You know, 1099s are great. But there are some catches to the 1099. So you do got to look at the guidelines. Some options require the income to come off from one contractor or provider, employer, whatever you want to call it. The independent contractor is our borrower. They're contracted by the company. Some 1099s option require that it only be one company contracting the borrower. So keep an eye out on that in your guidelines. But here again, same rates as the bank statement, 9.375 lowest cost option, 7.375 lowest rate option. Now, P&L, and again, 85% LTV. You know, success stories we've had with profit and loss loans and our new MLOs closing their first deals on a profit and loss loan. So right here, that's what we got and turned somebody's denial into our approval. They tried to put the square peg through a round hole, tried to force the deal to go full doc. They got denied. The borrower came to us. We analyzed the situation, met with our MLOs multiple times to help her structure the deal, and she closed it in a little bit over 3 weeks as a P&L deal. Not a bad deal. She made 16 grand to boot. And here, great rates. 9.499 is actually at par, and you can buy that down to 7.624. Got few more options for you. Now we're talking about self-employed borrower, but in this case, this is our borrower that says, Jose, no way, man. I got 35 properties. I'm in the middle of a bunch of projects. I haven't filed my tax returns this year. I'm going to get an extension. It's probably going to be filed sometime next year, and I don't want to deal with it. Then DSCR all day long. Keep in mind, this is the unicorn, 85% LTV, but you do got to be at a DSCR of 1.2 or above to get the 85% option, and it is only for 1 unit properties only. 2 to 4 unit properties are not applicable for this option. And again, here you're looking great rates. Remember, this is the unicorn, 85% LTV, 15% down DSCR, no mortgage insurance. And look at these rates, 8.75%, costing 1.4 points. You can buy that down all the way to 7.875 for a 15% down DSCR loan, which is pretty amazing. But wait, there's more. Now we're looking at our same self-employed borrower can close a 1 to 4 unit, no loan level price adjustments for going for the 2 to 4 unit option here. Right, so it's looking good because we even have a lender credit at 80% LTV. Look at that, 8% with a lender credit of 0.08. And this is what I wanted to show you. Look at that, 6.875 is your lowest rate option, 20% down, 2 to 4 unit, 1 to 4 unit, DSCR closing in an LLC. Amazing. And got 2 more options here for you. This is our low ratio DSCR at up to a maximum of 75%. Remember from our DSCR show we had recently, this is when the property does not cash flow on a 1-to-1 basis, right? Your gross monthly rent that's documented is less than the housing expense, but obviously this investor feels confident that they're going to improve the property, improve the cash flow. Maybe they're going to do short-term rentals on it and they're going to get double the cash flow of a long-term rent. They have the business plan for it. That's amazing because look at the amazing rate with only 25% down, 8.875 with a lender credit. We love those lender credits. Look at that. And you can buy that down to 7.75% rate for a low ratio DSCR. We're not even cash flowing and we're giving you the loan at 25% down. And last but not least, the ultimate mind blower for the DSCR less than 0.75. So you could have a property, for example, documented rent $1,500 a month, housing expense $3,000 a month. That's a DSCR of 0.5. We will still lend on that property with only 25% down and 9.75 with a lender credit, and you can buy that down all the way to 8.5% for a no ratio DSCR. So all of these different options today on how to assist your self-employed borrowers structure the loan in the best situation for them. So you really do have to understand their situation so that you can properly consult them and offer the best options, never forgetting the DSCR options that are always available.
Okay, great. I don't see any other questions besides the ones we had on Instagram. So I think we can go ahead and wrap it up here. Did you want to say something else, Nick? Oh, okay, sorry. All right. Well, remember, everybody, we do this 11 a.m. Eastern every weekday where we go through the live rates and then do a different loan topic. So we'll be back next week with some loan topics. Thank you, everybody, for tuning in. Thank you, Jose. Lots of great options there. And we will see everyone on Monday, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great weekend, everyone.
Thanks, everybody.
Have a great day, everybody.